Hey everybody, it's Danielle Damianov. This is being recorded. We had about 60 people register for this, so I'm gonna just give it a few minutes to allow people to join. And in the meantime, I'm gonna put a couple of PDFs in the chat, so that way you can grab the PDFs. One of them is a frequently asked question that just kind of goes over all of the different questions that we get on the all-in-one loan, as well as the brochure from one of the servicers of this product. This product is exclusive to CMG, but we are not the one that does the servicing because, as you'll see when I start the webinar, it does have some banking features and we don't have banking features. So I'm going to put the frequently asked questions in here, as well as information on one of the servicers. There are two different servicers on this product. And it is going to be recorded. So I am recording the webinar. Like I said, we had about 60 people that have signed up, and I've had a couple of people reach out to me, yesterday and today saying, I really want to be on this webinar, but it's during work or something came up. So I will be sending out the recording to everybody afterwards. So if for some reason you have to jump off, I'm going to try and keep it no longer than an hour. It should be about 45 minutes, I'm thinking. I'm definitely cognizant of everybody's time. I know how busy everybody is, but I really want to explain as much of this product as I possibly can, because in my personal opinion, this is one of the best loan products out there. It is not a difficult loan at all. It's a set it and forget it type of product. I actually have this on my home. However, it is kind of difficult to grasp. And so that's why I'm doing a webinar on it, to really explain to everybody all the ins and outs of the program, how it works, as well as, why I think it's one of the best loan products out there. So I'm going to share my screen. And can everybody hear me okay? Just maybe put it in the chat if you can hear me, as well as if you're able to see my screen right now. I just want to make sure that there's no technical difficulties. I was on a podcast a couple of weeks ago, and the person forgot to record the podcast. So we did an entire podcast with no recording. So just let me know, as well as if you have any questions as I'm going through this. Please know that I'm going to answer all questions at the end. If I don't know one of the answers to the questions, then I'll certainly let you know afterwards. We're going to be taking notes. I have somebody that's taking notes for me, so that way I can get everybody's questions answered. And a lot of times you'll have a question, so as you're thinking about it, I don't want you to forget, write your question in the chat, but just know, or the Q&A, but just know that I am going to answer all of them at the end, as well as, I'll answer them all at the end, but as I'm going through the presentation, a lot of your questions are probably going to get answered. So just want to check real quick. Okay, perfect. So chat is disabled. So everybody, if you have questions, put it in the Q&A. And like I said, I will be recording this, so I'm going to send out the recording to everybody afterwards. So we'll go ahead and get started right now. My name is Danielle Damianov. I'm with CMG Financial. Just want to tell you a little bit about me. I started my career in mortgage in 2001, born and raised in Massachusetts, moved to Florida on a whim in 2001. I had absolutely no idea what I wanted to do with my life, and got a career with Ameriquest Mortgage in Tampa. And from that point on, it was history. I've been in real estate. I've owned a real estate company, a mortgage company, from 2005 to 2009. Done a lot of real estate investing, and joined CMG in February of 2021. So I've been with them for about a year and a half, and was so excited when I joined them from another company because they had this all-in-one product. And the all-in-one loan actually has been around since 2005. So as we're talking about the all-in-one, a lot of you are going to think, oh my gosh, this is, a brand new revolutionary product, when in fact it has been around since '05. It used to be called the Homeownership Accelerator. And when I owned the mortgage company, was actually using and promoting this product. So it's a really, really, really great product. I'm so excited to be with CMG and have the ability to offer it. I am AIO certified, and we also do, aside from AIO, conventional, jumbo, FHA, VA, non-QM, basically any type of mortgage you can think of. I am licensed in Florida, Mass, California, Illinois, and Texas. However, if you are looking for this type of product in another state, I do have referral networks in my company, so I can always refer you to somebody that is licensed in another state. And then real quick, on the left is my contact info. That's my email, my office phone line, lendfla.com if you want to jot that down. That's my mortgage website. So there's a lot of information on there, and it's also where you would apply for the mortgage, or if you have a client that's looking to apply, you would have them go to lendfla.com. Loanrescue911.com. That is a brand new website that I just started. And basically it's for all real estate agents out there, just introducing myself and my team so that you know how we work and how we can help you grow and scale your business. If you're looking to get more information about this product after the call, or if you want me to sit down with you or one of your clients, or even talk about growing your business, book with D or bookwithdanielle.com is my calendar link. And then Realtor's Guide to Mass Production, that is a website where I have a lot of different tools for real estate agents on how you can grow your business. So I know on the call right now, we have a lot of real estate agents, but we also have a lot of clients that might be interested in the all-in-one loan. So this is the agenda that we're going to talk about. So first, we're going to talk about the all-in-one loan, what it is. I know a lot of people don't know exactly what this product is. We're going to then talk about how it works, and I'm going to go into a couple of different ways to really show you how this product works. So you'll have to bear with me a little bit when we get there. We're going to talk about how interest is calculated, the term of the loan. A lot of people ask me, well, what is my monthly payment with this loan? And I always let them know is you don't really have a set monthly payment. So I'm going to show you how that works. I'm also going to show you how you can save time, money, and interest, as well as paying your home off in record time without having any changes to your budget or your spending, not making any additional monthly payments on your mortgage, and then how you can also tap into that equity at any time. Because if you're a business owner, if you're a realtor, if you're an investor, if you're a financial advisor, if you're just a homeowner, you're going to see why, or a potential home buyer, you're going to see why the all-in-one loan is probably the best loan product, in my personal opinion, out there. And then we're going to talk about qualification, what it is, what does your credit score have to be? What are the certain things that we're looking at? And then I'll show you where you can go and take your specific situation and compare it to either a loan that you currently have or a loan that you're thinking about getting, and it is going to come up with a report that will show you exactly how this loan will benefit you. So that's our agenda. But before we begin, I just want to have a disclaimer here, because this loan is not for everybody. When I get a loan application, I look at the client and I'm always determining, what's going to be the best product for this client. And I can tell you, even though I personally think that this is one of the best loan products out there, it is not going to be for everybody. Okay. It is not going to be for people that do not cash flow every single month. It's not going to be for people that spend every dime, every month and have no additional monthly savings. And it's not going to be for people that need that peace of mind of having a set payment every month and, don't have to worry about their taxes and insurance, because the loan is not escrowed. You will be paying your taxes and insurance on your own every year. And it's also not going to be for anybody that does not want to combine their banking, their checking and savings accounts, with their actual mortgage. Some people are very particular with their bank and they just want to bank with that bank. So like I said, it is not for everybody. So if you're any of those people, it's not going to be the right loan for you. So anyways, before we begin and jump into the all-in-one loan, I think it's very important to talk about just a traditional mortgage and what we're used to seeing in the United States. So that way you can start to understand how the all-in-one loan is different than a traditional mortgage. So with a traditional mortgage, you're going to take out a loan. You're going to have your set payments every single month, unless you are in an adjustable rate mortgage, but still you're pretty much going to know what your monthly payments are going to be. For the first 5 to 7 years, if not longer, almost all of your money when you make your monthly payments is going towards interest. And we're going to take a look at that in a little bit. So you're actually paying interest to the bank first before you're paying your principal. Okay. And so if you think about it, unless there is a lot of rapid appreciation, which yes, we have seen a lot of appreciation over the past couple of years, and we may start to see some depreciation, but unless there is, rapid appreciation, your equity that you're growing is going to be slow. And the other problem with a traditional mortgage is that your equity is stuck. So equity is a great thing to have in a home, but when you do not have access to your home equity, what good does that really do for you, right? So your equity in a home is going to be the difference between what you owe on your home, so your mortgage, and the value of the home. So if you have a $400,000 home value and you have a $200,000 mortgage balance, that means that you have $200,000 in equity in your home. Equity is amazing, right? Equity is essentially cash, but the problem with a traditional mortgage is you have a liquidity issue. Your equity is a stuck asset. And I know a lot of people look at equity as an asset, but in my personal opinion, when you have an asset that is stuck that you cannot do anything with, it's not really an asset that's doing anything for you. So the equity, in my opinion, only becomes an asset when it can be converted into money, cash, or a way that it can be put to work for you. And that's really what the all-in-one loan will do. So with a traditional loan, okay, let's just say you have a traditional loan, whether you purchased a home with a regular loan or a refinance. How do you access the equity in your home when you have equity? There's really 4 options. Number 1, you can do a cash out refinance, which is just taking a lump sum out of your home. So let's talk about the $200,000 equity. If you do a cash out refinance, and I'm not going to get into loan to value and stuff like that right now, but if you want access to that $200,000, you got to take out a lump sum, and then you're paying interest on that lump sum amount plus your new mortgage balance that you've taken out. Okay. You can sell your home, but a lot of people don't want to sell their home. And over the past year, I have had so many people, and this is when the all-in-one loan is just obviously a no-brainer. I have had so many people say, Danielle, I feel like we're at the height of the market. I need to sell my home because I need to capitalize or maximize the value that my current home has. But I don't know where to go. And quite honestly, I love my home. I don't want to sell my home, right? So how can you access your home equity without selling your home and without doing a cash out refi? Because maybe you don't need the funds right now. So when I talk to you about the all-in-one loan, you're going to really start to understand how it works. You can also take out a home equity line of credit, which has similarities to the all-in-one loan, but it is different, and I'm going to go through the differences. And then your 4th option would be to refinance into the all-in-one loan. So those are the 4 different ways that you can access your home's equity. Okay. So when we talk about a home equity line of credit, you're going to see that the all-in-one loan has a lot of similar features to a home equity line of credit. Okay, but where it differs is that, first of all, what is a Heloc? A Heloc is a line of credit on the equity of your home. Think of it like a credit card. Okay, if you have $200,000 of a line of credit, let's just say, you only borrow whatever you need and you only are paying the interest on the amount that you borrow. So that's a great thing, right? However, it usually only has a 5 to 10 year draw period, meaning that that line of credit is typically only good for 5 to 10 years. And then after that, typically there's either a balloon due. I have people calling me saying I had a 10-year line of credit and my balloon is due. I need to refinance to pay it off. Or you have to make principal and interest payments until that amount is paid off and you're no longer allowed to draw on that line. So the other thing with a home equity line of credit compared to the all-in-one loan is a lot of times the amount that you can borrow on a line of credit is a lot less than what you can borrow with the all-in-one loan. Sometimes I'll see maximum Heloc of $300,000. Well, what if you have a $2 million home and $1 million in equity? So all you can take out is a Heloc for 300. I'm not saying that's the maximum amount across the board, but the line amount is a lot less than you can do with an all-in-one loan. You cannot also use or purchase a home with a home equity line of credit, because a home equity line of credit is equity on a home that you already own. So you cannot go purchase a brand new loan using a Heloc because you do not own that home yet. And a lot of times the Heloc is going to be combined with another mortgage. So on top of your Heloc, you're also having a mortgage payment, and those two interest rates together is what we call a blended rate. So your rate is going to be higher if you have a blended rate than it would be on just a regular all-in-one loan. So what is the all-in-one loan? Okay, so it's a first mortgage, which is different than the Heloc. It's a first mortgage home equity line of credit combined with a sweep checking account. And now this is one of the best features of this product, the sweep checking account. And I'm going to show you why in just a little bit. The all-in-one loan is going to allow you to tap into your home equity whenever you need it, never having to refinance again. Okay, so you're not going to have to refinance to get into your home's equity. With the all-in-one loan, you can tap into it at any time. It's going to save you thousands, if not tens or hundreds of thousands of dollars in interest payments over the life of the loan. It's going to allow you to use your idle cash to pay down the balance on your loan. So anything that you would normally have, think about what you have right now, okay? Not retirement accounts, 401ks, anything like that. But do you have a checking account or a savings account right now that has money sitting in it that's being, waiting to be used for a rainy day or to pay your bills or whatever the case may be? While that money is sitting in this checking account with the all-in-one loan, it's being used to offset or pay down the balance on your mortgage so that the interest that you're paying is a lot less, okay? And it also allows you to use the equity in your home to make more money and create that generational wealth that we all want. It allows you to invest in real estate. It allows you to invest more money in the stock market. It allows you, if you own a business, to use that equity for business capital or other investments to increase your net worth. And one thing I do want to point out real quick is that as I go through this, don't think in your mind, oh, I have to have a lot of money or be super rich to have this product, okay? Back in 2005, 2006, we had the product, and my in-laws, who were immigrants from Bulgaria, who did not speak any English, so they could not get a real, a great job. They worked in a hotel, and they did, the cleaning and the laundry and everything else. And they were in this product. We put them in this product because they don't spend every dime that they make, and they were able to pay off their mortgage in record time with using this product. So you don't have to have $1 million home or a ton of equity or anything like that to fit into this product, okay? You just can't spend everything that you make. So what is the difference between the Heloc and the all-in-one loan? First of all, the Heloc, as we mentioned, is a 5 to 10 year draw typically, where the all-in-one loan is a 30-year draw. Typically the Heloc will have a balloon due or having to make monthly payments after 5 to 10 years. With the all-in-one loan, and I'm going to show you how it works in a little bit, your line is going to start reducing after 10 years, but you still have access to that line for the remainder of the 20 years. It's just going to start reducing a little bit each month. So that way you're able to, you don't get to the end of the 30 years and say, oh my gosh, now I have to pay off this huge mortgage. We're never going to allow that to happen. Your mortgage will be paid off because of the line reduction at year 30, unless you refinance into another all-in-one loan. It's usually a Heloc combined with another mortgage or a standalone Heloc. And it does not have banking features, where the all-in-one loan is a first mortgage line of credit combined with that sweep checking account, combined with the banking features. So I know a lot of people have not heard the term offset mortgage, and you're probably wondering what an offset mortgage is. But the all-in-one loan is an actual offset mortgage. In the United States, you will hear about offset mortgages in commercial lending, in commercial banking. You will also hear about sweep accounts. In Canada, in Western Europe, in Australia, in New Zealand, this offset mortgage product is very, very, very common. So a lot of banks offer this type of mortgage product for residential mortgages in Canada, in Western Europe, in Australia, and in New Zealand. You don't hear a lot about it in the United States. And so in the US, all of our money that we make every month is going a huge portion towards interest. And we're stuck in this type of mortgage product. Okay, so the offset mortgage is not new. It's very common in other countries. In the US, CMG has had the product since 2005. So even though this might be a new concept to you that you're hearing, it is not an actual new concept. So an offset mortgage is basically a mortgage that is also combined with another deposit account from the same financial institution. So the savings that you have in an account that's combined with your mortgage is being used to offset your mortgage balance, which then in turn lowers interest payments that are due on the loan. And I'm going to show you an example of it in a minute. So when I had mentioned in the beginning, if you're one that only wants to bank with, your credit union down the street, with this mortgage, you are going to get another checking account. And that checking account has to be used in order for this to really work. I mean, there are some ways around it, and I can talk, about that on a one-on-one basis on how we can, make it work if you still want to use the credit union. But you're going to want to really utilize this checking account that comes with the mortgage. So if we look at our conventional loan structure in the US, the problem is not the interest rates that we have, right? The problem that we have with our traditional conventional loan is two things. Number one, money is only flowing into this mortgage, okay? So if you take out a $500,000 mortgage and you sell an investment property and you get $100,000 and you say, oh, I now want to put $100,000 down on my $500,000 mortgage, that's great. You can go ahead and do that. Unless you recast the loan, which is a completely different situation that a lot of actually people don't even know about. But unless you do something like that, your mortgage payment is not changing. You're still paying based off of your $500,000 mortgage that you took out. And that $100,000 that you put down on that mortgage is now stuck equity. It's stuck in your home. You can't access it unless you do one of the four things we talked about a little while ago. So money only flows in, it is not flowing out. You have to remortgage if you want to get that cash out or take out just a standalone line of credit. And take a look at this graph, okay? Look at the interest, which is gray, and look at the principal. The majority of your money, your hard-earned money, is going to interest. You're paying the bank interest, okay? A lot of interest. So take a minute and think about how expensive everything is right now. With inflation, like health insurance is insane. The cost to eat is insane. Everything is so expensive, okay? And now with this type of mortgage product, your money is also getting stuck in here, not be in a traditional mortgage, not being used for anything else. So if we take a quick look at an amortization schedule, this is on a $185,000 mortgage at a 4.125% interest rate. Look at your principal payment. If your monthly payment is $895, you have $260 going towards your principal and $635 is going to the bank's interest. That is money just literally getting thrown away, right? Because it's not doing anything for you, and nor is it going to you, nor is it paying down your mortgage. And then if you look down to month 12, after 12 months, you're only paying $10 more towards your principal after a full year of making these payments. So you're paying so much more interest to the banks. And this is why banks really don't want you to know about the all-in-one loan or this offset mortgage. And so with the offset mortgage, a lot of times people will say to me, well, then what's in it for the bank? Because this right here looks amazing for the bank. The bank's getting all of this interest. They can then take the money and, do whatever they want with it, use it for their benefit, but it's not benefiting you at all. And so if you go into the all-in-one loan, how is that going to benefit the bank? Well, when you combine your banking, okay, your checking or savings account with your mortgage, that particular lender, the servicer of this loan, is also using, is also gaining a customer, a banking customer. So that is one benefit to them. The other benefit to them is that this is a long-term play. I mean, mortgage companies and banks know that on average, you are going to either refinance your home because you need access to your equity, or you're going to sell your home every 5 to 7 years. With the all-in-one loan, unless you sell your home, there's no reason to refinance this mortgage ever again, unless you're 10 years into it. Now you have so much more equity and you want a larger line of credit. But you're really not going to have to, remortgage this the property. So that's kind of what's in it for this mortgage lender. Is it's a long-term play, and they're also getting your banking. So let's talk about how offset mortgages work, because I might have confused you a little bit with the checking account, savings account. So we're going to go through a couple of examples here. And I think at the end of this, you're going to have a really good understanding as to how it works. So when you have an offset mortgage, you have your principal mortgage, the mortgage on your home, okay? And then you have your checking or savings account. If you don't do an offset mortgage right now, whatever's in your savings account is sitting there. It's not earning you any money. It probably earns you a low amount of interest, okay? You now have a mortgage that is a high amount of interest, right? With the offset mortgage, anything, if you have money sitting in a savings account or a checking account, not doing anything, and you get the all-in-one loan, and you are now using the checking account that's combined with the all-in-one loan, all of that money that's sitting there not doing anything, maybe you have $5,000, maybe you have $10,000, maybe you have $100,000, maybe you're a business owner that brings in tons of money because you own a construction company every month, tons of money every month. And even though a lot of money goes out every month, that money, while it's sitting there, is being used to offset the balance on the mortgage. And so interest is only getting charged on whatever the particular balance is for that day. So if you take out a $800,000 mortgage and you have $100,000 just sitting there in an account, right, not really doing anything, that $100,000 is going to automatically sweep over and pay the balance down on the mortgage to $700,000. Okay. Now, when you get your checking account, you're also going to get ATM cards, checks, bill pay. You have mobile deposit, everything you would have for a normal checking account. So you're going to use that checking account just like you would use any other checking account. As I mentioned, I personally have this on my home. We were just in Europe. We use the ATM card all the time, right, to get cash out of the ATM. So when I use the cash out of the ATM, what's happening to my mortgage balance? It's going up and down. I don't have to go and move money from my checking to my Heloc or my Heloc to my checking in order to pay bills. It's an automatic thing. Now, I just want to do a quick disclaimer here because we just got the all-in-one loan in Texas because they have some really funky Heloc rules. And the way that it's set up in Texas, it is not an automatic thing. So if you're interested in this loan and you are in Texas, then we will show you exactly how to set it up. But if you're not in Texas, it's a set it and forget it type of thing, because whatever you deposit into the checking account is automatically sweeping over, keeping the principal balance down on your mortgage. Your interest is getting charged, daily at the end of every day. It's an automatic sweep. There's nothing that you have to worry about, nothing that you have to do. You can go to Costco and use your ATM card, whenever you want, and your balance on your mortgage is just fluctuating because these two things are essentially combined. So any deposits that you make into that checking account is going to lower your principal balance. The interest is charged every day, and I'm going to show you how that works in a minute. But that money's keeping your balance, your principal balance low. Now, as you withdraw money, you go and pay bills, you go to Costco, you pay the car bill, the kids' school, whatever, that balance is going up and down. But the amount that's left over in that account every month is being used to reduce the principal balance and keep it low until you need that money. So any money that is not spent from your account every month is always working for you. Think about it. What do you have in a checking or savings account right now that is earning you any sort of good type of money? Nothing, right? So if you put it in this checking account, what that money is doing for you is it's working for you. It's keeping that balance low, so you in turn pay less interest over time and in turn pay your mortgage off in record time without doing any additional monthly payments. You're not changing your spending. Your spending might actually change because you might get excited once you start to see how quickly your balance is going down, that now you want to save even more because you're going to get more equity, and equity means more money means you can do more things, right? So this is going to provide a level of flexibility and control that conventional loans do not. It's also going to resolve a series of issues that conventional loans create, which is stuck equity, liquidity problems. You're going to be able to use the idle funds that you're not using right now to offset your mortgage savings. You're going to increase your equity. You're going to pay off your home in record time. This is the only loan that pays principal first, because everything you put into that checking account that sweeps and pays the mortgage down is your principal payment, right? So anything you put in there is going to principal. Interest is charged at the end of the day, not charged, but calculated at the end of the day. So this is a principal first payment. We already looked to see how much money you spend in interest over the life of a traditional loan, where with this, you're paying principal first. With the conventional traditional loan, you're paying interest first. And this is another thing to point out, okay? As long as you have equity on the line, you're not going to get hit with any 30-day credit liens. Okay, so let's just say you're a real estate agent and your income is sporadic. Some months you have great months, and then you have a lull of like not making anything for a couple of months. Those months that you are not depositing anything into the checking account, as long as you have money on the line, you don't have to deposit or make any sort of payment. Yes, your interest charges are going to increase, but you're not going to get a 30-day late on your credit report, right? In a traditional mortgage, if you lose your job and you don't make a payment, well, you're getting hit with a 30-day credit late, right? And that's going to continue until you start to make your payments again. With this mortgage, if you get into a bind or you're out of work for however many months and you never got disability insurance or whatever the case may be, as long as you have money on that line, you don't have to make any payments until it gets to the actual credit limit. Okay, so this can help people as well. And then use the equity to fund investments for you. So we're going to talk about the 5 benefits here, and then I'm going to go a little bit deeper into showing you how it works. So obviously we talked about how you can save tens of thousands of dollars in excessive mortgage interest, which is what the banks charge and why they don't want you to know about this product. It's going to leave more resources or more money for you to be able to fund other investments or real estate investments. You're going to build equity in your home so much faster than a traditional loan. You're going to pay off your home in record time, sometimes half the time. I just did a simulator for somebody who has amazing cash flow, and it was 2 years. He was considering a 15-year fixed. We looked at the all-in-one loan. He'd have this paid off in 2 years. And then he would still have a line to use for whatever he wants, whenever he wants. Because when the line gets to 0, the line is still open until you actually close it. So that means you have all of that money to use at your disposal for whatever. Maybe you want to go buy 1, 2, 3, 4, 5 Airbnbs, and you need $50,000 for a down payment on each of them, right? And you're getting a regular mortgage for the other, or an all-in-one loan on the other. You can use that money for anything that you want. You can access your home equity freely for 30 years without having to refinance. And then, as we just talked, it creates that security blanket. It reduces the risk for borrower default, because if you default on your mortgage after 90 days, if you're not paying, you're probably getting a lis pendens in the mail or some sort of notice of default. Okay, with this loan, as long as you have money on the line, it doesn't matter if you make a payment or if you do not make a payment. So a lot of times when I ask people this, and it was a difficult concept for me to understand, you know, what matters most to you when you're borrowing money? Is it the interest rate that comes with the loan? Or is it the amount of interest that you pay on your loan? And most people will say, well, if it's a 6% interest on the all-in-one and 4% interest on a 30-year fixed, I'd rather go with the 4%. But think about it. It's the amount of interest that you're actually paying on your loan. Because if you take out a traditional mortgage at 4%, okay, that 4% is being calculated interest on that amount that you take out. Where if you take out the all-in-one loan, it's simple interest. It's interest charged that day on whatever the balance is. On a traditional loan, the interest is charged on the actual loan that you take out. So the all-in-one loan is an innovative loan that completely changes the way that we should be thinking about mortgages and about money. And it's really a loan that not all of the banks want you to know about. So it's engineered to help you avoid a significant portion of interest that's charged over the life of the loan, allowing you to eliminate your housing debt, your mortgage debt rapidly, more comfortably, and giving you access and the freedom to do what you want. So let's talk about some features of the loan real quick, and then we're going to get into a little bit more in detail of exactly how it works and the benefits of it and who it benefits and why it benefits real estate agents and financial advisors and business owners. So this is available for both new purchase and mortgage refinances up to 2 million. I've heard of some exceptions to 5 million. Okay, so that's not the norm. But if we have if we have a higher loan amount than 2 million, we can certainly talk about it. It is a 10% down payment or equity position if you're refinancing. Anything over an 80% loan to value will have monthly mortgage insurance, which is typical with any loan. Okay. Primary residence, second home, or investment properties, you can do this loan on. About 30 to 45 days after closing, you're going to get your ATM card, your check cards, your online bill pay portal. I have this loan. I have an app on my phone. It is so easy to use. If you get checks in the mail, you do a mobile deposit. You also get regular checks. You have set up with online bill pay. Every single thing that you would have with a normal checking account, you have with this, and it is so simple and so easy. And I can personally tell you how amazing the concierge, all-in-one concierge loan department is in this, in these loan servicers. In the chat, I did put one of the servicers brochures in there that has all of their banking features. This changes. I know it says mobile deposits using the app, $25,000 daily limit. I know someone that just did a $50,000 deposit because they got a bonus from their job. So just because it's saying that doesn't mean that that's actually the limit. You can access the account 24/7. You get the monthly mortgage statements. You can get them online. You can get them in the mail. When you get your mortgage statement, these are combined. So you're going to see your checking account. You're also going to see your mortgage balance. And you're going to look at the checking account and say, oh, I have nothing in my checking account. It's going to look like zero, right? Because it's being used to keep the balance low on the mortgage. But on that same statement, it's also going to tell you your equity position or the amount available to you on the line. So my actual loan partner was looking at one of these statements recently, and she's like, they have nothing in their checking account. And I'm like, well, you have to look at the statement because it shows right there what their equity balance is, which is an asset. So I can also tell you that we have the best, both servicers and CMG, the best client concierge. And I said, think of Amex Black Card service, because I had somebody that called me recently. I did the all-in-one loan for them. Before we even closed, they said, Danielle, I did some research, and I'm just throwing this out there. I did some research on North Point Bank, and it looks like their servicing department is not good, and I don't want to go with them. I want to be put in a traditional loan. And so I did a couple of things immediately. First, I called every client that I recently closed that had closed with North Point Bank to ask for their opinion on it. They said that they are phenomenal. I then called my all-in-one loan department, who said, Danielle, North Point Bank and then the all-in-one loan portion of North Point Bank or Merchants Bank are two totally different things. You have a client concierge specialist that knows about the all-in-one loan. You're not going to call and get some random person from some other country that does not know exactly what they're talking about. You're going to get somebody that picks up the phone and talks to you. In fact, when I was going to Europe, I called them to let them know I'm going to be using my card. And because I was in another country, the same lady that I spoke to before I left for Europe called me in Europe and was like, are you in Bulgaria? And I was like, yes. And she's like, okay, just making sure. I didn't know. I know that we had these other countries on the list, but I didn't see that one. So I'm telling you, they are amazing. The servicing is incredible. Whatever you need, they're always there for you. So let's look at the line of credit structure. Okay, so we talked about a 30-year draw. Okay, there's no balloon payment at the end. You don't have to start making principal and interest payments. Why is that? Well, that's because after 10 years, for the first 10 years of the loan, the line of credit is the exact same. After 10 years, the line of credit is going to reduce by 1/240th each month. So basically, each month for the next 20 years, it's going to reduce a little bit. So that way, when you get to year 30, you do not have a huge mortgage that you have to pay off. You actually have no mortgage because the line of credit is reducing every single month. Now, keep in mind, I don't want you to get nervous like, oh my gosh, where's my equity? Your equity is still there, right? Because your equity is there until you sell your home. So you're always going to have your home's equity. Just the line of credit that you can use on your equity is what's going to be reduced. So if we look at some of the ways that this loan works, which is amazing, if you take out an $800,000 credit limit, okay, and you start paying down your mortgage, and oops, now we want to put in a pool and we're going to redo the kitchen and the bathrooms. Well, you just go and take your money right out of the line of credit and you put in the pool or redo the bathrooms. And the other really good thing about this is that if you look at a cash out refinance, for example, if you take out a cash out refi because you want to do a home remodel, two things that are happening here. Number one, you have to take that lump sum at closing. So if you take out a $200,000, you have a $200,000 mortgage, you need $100,000 for your home remodel. Well, now you're taking out $300,000, but maybe you don't need $100,000 right away, right? Maybe you only need a portion of it because you're going to first do the kitchen and then a year later do the bath, but you don't want to refinance again, whatever. With a cash out refi, you don't have an option. You're taking that money out lump sum and paying interest on it immediately. With this, you can take out a line of credit, okay? But at closing, let's just say, I'm going to talk about a refinance for a second. Let's just say you owe $400,000 on your mortgage and you have you take out an $800,000 credit limit. You know in the future that you're going to want to do a remodel and you're going to have to pay for your kids' college and you probably want to travel the world, blah, 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 whatever you want to do. At closing, you can take an $800,000 credit limit, but only a $400,000 initial line amount to pay off your current mortgage and have $400,000 sitting there on the line, not paying interest on, to be able to be used for whatever you want, whenever you want. You may never even need it, and it doesn't matter, right? Because you're not paying interest on it, so who cares? So when you get the mortgage, you do have to take a line amount. So if you own your home free and clear, you can't just be like, oh, I want an $800,000 line, I'm not going to take anything out at closing. You can't do that, right? But you don't have to take the full line amount at closing. Now, on a purchase, you do. So if you're purchasing with this type of loan and we take out an $800,000 mortgage purchase, remember, if you have let's just say $400,000 sitting in a checking or savings account, not doing anything, after you close on your home purchase, you can start to move money into that checking account that you're going to want to use anyways. And that's going to pay your line down immediately and also not have to pay interest on it. Okay. So a lot of people will ask me, so what is the interest rate for the all-in-one loan? You have three different options. You have a 1 month adjustable. You have a 3-year fixed option where it's going to be a certain rate fixed for 3 years. After the 3 years is up, it's going to adjust every month. And then you have a 5-year fixed option where it's fixed for 5 years. And after the 5 years, it will adjust every month. I left a 3.75% interest rate that I've already paid 6 years into the mortgage on for a 1 month adjustable, because that's how much I believe in the fact that it does not matter about the interest rate, because it matters about the loan balance and the cash flow that is going through the account. That is the most important thing. So how do we determine what the interest rate is? The interest rate is the CMT. It used to be the LIBOR. Last October, I think it was October, it changed to the CMT index. You can pull the CMT index. Every month I get a rate sheet. It tells me what my CMT index is for that month. Okay, let's talk about the 1 month adjustable right now. You then have a margin. So if you're doing the loan with me, I give you the options on the margin. The margin can be anywhere from 2.5 to 3.75. Depending on your loan program, that margin is going to be different. Some people like to pay points to buy down their interest rate, right? It's the same thing with this. You can pay points to buy down your margin. So when I go to give you your rate, I will give you what the rate is, what the margin is with no points, what the margin is if you wanted to buy it down with points, or what the margin is if you wanted to get a credit at closing to go towards closing costs. And it's kind of confusing, you know, if you're not really familiar with this. So it's something that I make super simple over the phone. It's a little bit more of a visual. So the interest rate is going to be the CMT index, whatever it is for that particular month that we're locking the loan at, plus the margin. So if you go with a 3.75 margin, okay, and the CMT index is at 2%, then your interest rate, your fully indexed rate is 5.75 for that month. Now, the next month, the CMT might change. It could go down, it could go up. If you're in the 1 month adjustable, your margin is constant. Your margin stays the same, and you're going to take your margin and then add the CMT, whatever it is for that month, on top of your margin. And those two together is going to be your interest rate for that month. The lifetime cap is whatever the index plus the margin is that we lock it at, plus 6%. And the lifetime floor is at 3.75. So what the lifetime floor means is that if the CMT index is at 0 and you buy, which is not going to happen, but let's just say, and you buy the margin down to 2.5, well, then your rate is 2.5, but the floor is 3.75. So 3.75 is what your interest rate would be. Rates in the 2s and 3s is an anomaly. Okay, that is not going to probably ever happen again in my lifetime. The historical interest rate on this product in CMT has been between 5.2 to 6.5%. Okay, when I bought my first home in the early 2000s, my rate was 7.5%. That was the going interest rate. So what we're seeing, rates in the 5s and 6s, that is average. That's an average rate. If you're sitting on a mortgage right now and your rate was 2.75 because you were a VA and you got a vet and you got a VA loan like 2.5 years ago, you know, we would want to do the simulator and see. It's all going to be based off of cash flow and how much idle money you have. You can still get a mortgage all-in-one loan at a 6.5% interest rate, compare it to a 2.75% interest rate, and pay off that mortgage a lot quicker than what you currently have due to your cash flow. So here's how it works. We kind of went through this, but I want to go through this one more time so you can also see, we talked about the idle cash that you have. But the other thing that you're going to do is you're going to set up your direct deposits into this checking account that's combined with the mortgage. So if you take out an $800,000 mortgage and your monthly income, net income, so when you're doing the simulator that I'm going to show you in a little bit, you want to do your net income. How much money are you going to deposit into this account every single month? So you start out with an $800,000 loan. Month 1, your income goes in there. You deposit $14,000. Your new mortgage balance is $785,000. That cash that you have is automatic equity. The $14,000 is automatic equity, okay? And it's also automatic money. So you can use it. You go and you pay your bills, you pay your car. Maybe you have an Ameriprise account and you put $500 a month to your IRA, whatever it is, all of that money then comes out. But on day 1, your $800,000 mortgage, this is how the interest is calculated. So if you took out a mortgage of $800,000 and your interest rate was 5.2, you're going to take the 800 times 5.2 divided by 365. That day, your interest charge was $114. Now, it's not leaving your account that day. It's just being totaled up that day, which is another really cool feature on the loan because the interest is not getting tacked on to the mortgage that day. It's getting totaled up at the end of the month, and all of those daily interest charges, which are going to fluctuate, will get totaled up at the end of the month. And then it's going to come out on the 21st day of the following month. So as you can see, your $14,000 check went into the account. Your mortgage balance is now $785,000. Your interest rate is still the 5.22. At the end of that day, the day you got paid, your interest is now $112 for that day. Okay. And so it is now going to total all of those interest charges up at the end of the month. and it's going to automatically draft the total amount on the 21st day of the following month. So I am not a financial advisor, nor do I pretend to be. And I can also tell you that this simple math, I understand, but actual math, calculus, all that other stuff that my kids are taking right now, I'm just like, whoa. But this, think about it. That money that needs to be drafted out of the account, the interest that needs to be drafted out of the account, it's not taken out until the following month on the 21st day. So you have all of those additional days of saving, because the interest is going to tack on to the principal balance, of saving money, right? So it is just another great feature of the all-in-one loan. And that is how interest is calculated. And that is why you do not have an actual monthly mortgage payment, because we don't know, you don't know what your spending is going to be every single month. You don't know, maybe you got a bonus one month, or maybe you bought an investment property and now you have rental income going into this account, or maybe you got a lump sum from, you know, whatever, and you put it in here. So your principal balance on your mortgage is going to go up or down depending on the income or money that goes into the checking account and the money that flows out of the checking account. So you can see with that example, if they took out an $800,000 mortgage, they put $14,000 into it from their direct deposit. Their expenses for that month were $7,400. The interest for that month was $3,400, which is then taken out of the account on the 21st day of the following month. That is how the mortgage is essentially paid. Your principal payments on the mortgage is any dollar that goes into that checking account, whether it's from your direct deposit, whether it's from Social Security, whether it's from pension, whether it's from your rents that you receive from investment properties, whether it's from dividends, whether it's from bonus, whether it's from whatever, anything you deposit into that account, including the idle cash that might just be sitting around somewhere, is being used to offset the balance on the mortgage, which will in turn, charge so much less interest over the life of the loan, as well as allow you to pay off this mortgage in record time without having spent any additional money on additional mortgage payments, and you have access to that equity at any time. So hopefully you're starting to understand this a little bit better. So if we look at month one, there was $6,900 that was saved at the end of month one, because that is, they had their $7,400 expense, their $14,000 income, $6,900 is left over. Now think about this, if that $6,900 stays into that account, now they put another $14,000 in the next month because that's their income. They spend the $7,400 a month because those are their monthly expenses. Another $6,900 is sitting on that mortgage. That's $14,000 now, right? That's keeping that balance low. And you still have access to that equity if you need it. But if you don't need it, keep compounding over month after month after month, and your home is going to be paid off in record time. So how do you qualify for this? We're going to talk about that, and then we're going to talk about the benefits for real estate agents and everything else. And I think you're kind of starting to hopefully see the benefits. But first of all, we follow conventional guidelines. What is amazing about this is traditionally nationwide, a jumbo loan is anything over 648 right now, I believe. Okay. So if you have an $800,000 mortgage, you're falling into jumbo guidelines. Jumbo guidelines are stricter than conventional guidelines. Okay. This follows conventional guidelines up to $2 million. You need a 700 credit score if it's an owner occupied property or a second home. You need a 720 credit score if it's non-owner occ. If you are doing 10% down, you need a 760 score. This is where some people get tripped up with this mortgage, okay? If your debt to income ratio is 40% or below, you need 10% of the line amount in reserves. It can be anything. It can be checking, savings, retirement, 401k. It cannot be your Mercedes GL, blah, 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 that you own free and clear. That is not reserve. That is not liquid. It has to be liquid. So what that means is if you take out $800,000 and your debt to income ratio is at 40%, well, then you need to have $80,000 in some sort of reserve account, checking, savings, retirement, somewhere. Okay, it can't be a gift, it can't be equity on another line of credit. If your debt to income ratio is at 43%, which is the maximum for this program, you need 15% of the line amount in reserves. So that is where some people get tripped up because they don't have the savings. And with this product, this is how you can save more money. So if you don't have the reserves, think about how you can save the money for the reserves, because once you're into this product, you're going to save so much more money on interest. You're going to allow yourself to have the liquidity to be able to invest more in the stock market and investments and real estate investments, to buy Airbnbs, to do whatever it is that you want to do. So you have to make sure that you have the reserve amount. 100%, we can use 100% value of a retirement account, which is not traditional in this type, in a conventional loan. Typically we have to use 60 or 70%. So that's another great thing. We can use it on only residential properties, single family, 2 to 4 units, condos. It can't be a 5-plex, it can't be land, it can't be a construction to perm product. I don't know if we can do it on a manufactured home. So residential properties is all we can do this on. And then when you take out the minimum, when you take out the loan in the beginning, this is something else that pops up a lot. Okay. When you take out the loan, an $800,000 mortgage, let's just say, you're not going to get $800,000 at closing. We have to leave 1% on the line. So we are only going to lend you 99% of that maximum credit line. Now, when you take out 800,000, you have up to 800,000 to spend. We're only going to give you 99% of that at closing. So the difference between the two is left on the line. It's allowed for you to use afterwards, but it cannot be initial because of a couple of reasons. First of all, it's going to take about 45 days for you to get your banking, your checking, your ATM cards, all of that stuff, right? So you're not going to have any sort of deposits or anything going into that account right away. So we have to leave enough on the line, and a lot of people get busy, right? You're not going to get something in the mail and set it up that day. If you're like me, it might be a week. If my husband didn't do it, hopefully he normally does. But anyways, so it might be a little bit of time before you set that up. So you can't max it out at closing. So we only lend 99% on the credit line at closing. So here's a couple of really cool things that I want to point out. Delayed financing. So you're probably wondering what delayed financing is. Delayed financing is when somebody goes and buys a home cash, but they want their money back, right? Typically with, there's something called delayed financing where we can either do a delayed financing loan, or if you want to do a cash out refi and you purchased a home cash, usually you have to wait 6 months before you can get your money back. With a line of credit, at least with a local lender that I know of, it's 1 full year. You cannot get your take out a line of credit on that property for at least a year. With us, there's no seasoning. Okay. You can also pay off another Heloc that you did not get at the same time you purchased. There's no seasoning on that. The asset depletion part of this loan is incredible. And the reason why is because I have had so many people qualify for this mortgage that did not qualify for another loan. And I'm going to give you a couple of examples. Assets can be used as income. Okay. So if you are less than 62 years old and you have money in retirement accounts, stocks, bonds, blah, 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 whatever, I can take 70% of each of those accounts, divide that amount by 120, and whatever figure that is, I can use that as income to go against your debt to income ratio. I recently had a client come to me, they're self-employed, and of course, every self-employed person that does not understand mortgages think they make a ton of money, and when I get the actual tax return, they like either make nothing, a little bit, or not anywhere close to what they actually thought they were making. So they came to me, they were trying to buy like a $900,000 home. And I'm like, you only make $50,000 a year. It's not going to qualify for a traditional loan. So I said, let me look into the all-in-one loan. Well, sure enough, they had all of this money sitting in retirement accounts and everything else, because when you're self-employed and you're trying to avoid paying $1 million in taxes or however much, you write as many things off as you possibly can. And so the actual net income on your returns shows a lot less than what you actually make. So you don't qualify. In loan world, we don't care if your gross income was 2 million and your net income is 50,000. Net income is what we use. There are a couple of add backs, but I'm not going to go into underwriting guidelines here. Anyways, the awesome thing is I can use money from assets. I had another guy who we just closed on him last month. Okay. Could not get a mortgage anywhere. His debt to income was too high. He is on Social Security and pension. He owned his home free and clear. It was a condo. Value was 400,000. He only wanted to take out about 200,000. His debt ratio was super high, but he had reserves. He had money in the bank. So by using the money in the bank as income, I was able to qualify him when nobody else was able to get him qualified. So real estate agents, hear me out on this. This is huge because you might have clients that are asset rich, but I don't know if you would say income poor or just don't make any money, right? But they have the assets that they're living on. I can use assets for income, and you might be able to get your home buyers into homes that they may not have been able to get into otherwise with this product. So we are able to do a lot of different things. I'm going to show you another example in just a minute. We're almost done. We're going to go through a few more examples, and then this is another great, amazing feature about this product. There is no minimum amount or maximum amount of advance at closing, like there would be with a cash out. However, you do have to take something out at closing. Okay. So if you want, you have a $400,000 mortgage balance, and let's just say, and actually this is a really good example. Those people that wanted to tap into their equity of their home, but don't want to sell their home, but don't know what they want to use the equity for. If anything, let's just say you have an $800,000 home value and you only owe $300,000 on your mortgage. We can lend you 80% on the $800,000. At closing, only take out $300,000 plus closing costs to pay off your mortgage, and you now have access to all of that equity in your home, but you're not paying interest on it, and you don't have to use the equity. It's just going to sit there to use for whatever you want, whenever you want, and available to you for 30 years. So this is another great way for those people that are saying, you know what, I kind of do maybe want to buy another home or an investment property, and I'm stuck in the equity, I'm stuck in my mortgage. I have equity there. I don't know how to tap into the equity, but I don't really need it right away. I don't want to pay interest on stuff I'm not using. This is the perfect loan. So anyways, who is this right for? As I had mentioned, my in-laws, okay, literally came to the United States, no English. They are back in Bulgaria now and still don't really speak English, but they had this loan. They worked in the hotel because of their English barrier, and they are savers. So they were able to pay off their home in record time. They didn't pay it completely off, but they paid it down a lot. So when they sold it, there was actually a good amount of equity. So whether you're salaried, whether you're commissioned, whether you're self-employed, whether you're retired, it does not matter. It's good for anybody that has positive cash flow. We just talked about why this is important for realtors, but I want to give real estate agents a couple of examples. First of all, this loan is going to set you apart from every other agent out there, because a lot of times I have my broker associate license. I've been a licensed realtor, even though I do not practice at all, but I know what you're going through. And a lot of times you want to figure out what your positioning is in the market. How do you separate yourself from all of the other real estate agents out there? And a lot of times it's service, it's this, it's that. But the other thing that you can offer them is how to properly structure deals in a way to get you or get your clients more money, right? Or get them into homes that they didn't think that they were able to get into. The other thing is clients might have cash, especially right now. They have cash, but they're scared. They don't want to use it, right? They don't want to tap into it, or the market is down for them so much. They got money sitting in their Morgan Stanley account that they don't want to take out because they are $100,000 down in the market and they need to earn that money back. Well, guess what? They can take out the all-in-one loan. They get the loan, but have that flexibility to do a couple of different things. Number one, pay off the line to zero whenever they want to, leave that line amount open to give them more options to buy more properties, right? You will also have clients that might have cash, and this just happened on another loan recently that I closed last month. You might have clients that, and this is the example here, I had a client that was referred to me. Actually, he was referred to me because he was working with a real estate agent, and the real estate agent said, "Look, they just sold their home in New Jersey. They only have $300,000. They're looking to buy up to $300,000, but we cannot find them what they want. They don't want a large mortgage. They don't want to get stuck, in this 30-year fixed payment or whatever." So we did the all-in-one loan. They have $300,000 sitting in a checking account that they were ready to put down on the mortgage, right? But instead, what they did was they bought a $400,000 home that they absolutely loved, that they didn't qualify for before because they didn't want the mortgage. They only had $300,000 in cash. So we were able to not only get them that $400,000 mortgage, they can then start moving their money around. So that way their money is now paying that mortgage down quicker. So they're not going to be stuck with that mortgage. And here's the other cool thing. That $400,000 mortgage, or I'm sorry, $400,000 home that they bought, they told me, "Danielle, we love this home, but this is not the area that we really, really, really want to be in. So my thought process is to buy this home 2 to 3 years from now. Maybe we'll go ahead and either sell it or rent it or Airbnb it or whatever down the line." So guess what they can do? They can decide that when they want to, but they don't have to sell this home in order to buy something else, because now they have equity that they can use to go and buy another property. Or maybe they took out the $400,000 mortgage. Over time, they get that balance down to 100. They now have $300,000. They can go buy 5 Airbnb properties if they want to, right? Here's $100,000 down on, or $50,000 down on each. So when you purchase with the all-in-one loan, if you have other money in the idle accounts, you can then move them over afterwards so that your cash is then freed up again. Plus you have the equity to be able to use. Another example here is I have a lady, thanks to a good real estate friend of mine, who is a business loan funder. Basically what she does is she finds people that need money for their business funding. She does SBA loans, anything to help them get money for their business. Okay. So there's a lot of different business loans out there, but not everybody qualifies for them. Number one. Number two is the interest rates could be quite high. Number three is the amount of time it could take to get an SBA loan. Let's just say 3 or 4 months, though the funds might have been needed, immediately. I can close one of these loans. I've closed one in 3 weeks. So if we have clients that are working with us and that are moving with us, moving and shaking and doing what we need, we can get these done quickly. So if you have equity in your home and you're a business owner and you need funds to grow and scale your business, this is the perfect loan for you, because maybe you need funds or capital to grow and scale your business. But guess what? Once you use those funds to grow and scale your business, you're now tripling or quadrupling your income, that you can then take those funds and throw it back into the mortgage. And now you're down to maybe nothing, right? That line stays open for 30 years until you actually close it. Maybe you need funds to invest in real estate or the stock market. I know a lot of people right now, the market's down. There's people that are pulling out and there's people that are putting everything they have into it. Okay. So maybe you want to put more money into the stock market. Maybe you have this amazing business idea and you need funds to start your business. You can use the equity to pay off, borrow, pay off, borrow, pay off, borrow, pay off for the entire 30 years. It's an 80% loan to value based off of the appraised value. It is a first mortgage line of credit. So if you currently have a mortgage, we have to pay off that mortgage at closing as well. But this is such a great idea or a great way for people that have businesses to get business capital. And then the other reason why this is really good for business owners is I just had a guy, we actually closed him last month as well, in the all-in-one loan. He was initially going conventional, was not able to qualify for the all-in-one loan right away because of the reserve requirement. But as luck would have it, he got a huge business check that was due to him, and we were able to do the all-in-one loan. And so he runs a business, and his business brings in large amounts of money every month. He might bring in $30,000, $40,000, $50,000 a month. Now he might be spending, right? Let's just say he's bringing in $40,000 a month. He might be spending $35,000 a month, but until that $35,000 is being spent, he's flowing everything through this checking account, which is automatically dropping his balance 40 grand. Interest is charged on that balance. It will continue to be charged on that low balance until he uses the money to pay it. And then maybe he has, 7 days a month where that balance goes up $35,000. But if you own a business, to throw your money into this checking account to be used to pay down your balance and keep your interest low is another amazing thing. So it's great for people that own businesses. As I had mentioned before, it's great for people also that might have sporadic income, because if you get $40,000, $50,000 a month, or even $10,000 a month, and then you have nothing for a couple of months, well, as we talked about, you don't have to make that monthly mortgage payment. You're not going to get a list pendants in the mail, and you are not going to get a 30-day late on your credit report. If you own your home free and clear, and you want to buy an investment property, you can take out the all-in-one loan. You've got to take money out on the line in the beginning, but you now automatically have access to your home equity, so that when that opportunity arises, you can cut a check. Right? So you're cutting a check. If you want to buy a $300,000 condo on the beach, you can cut a check for $300,000 from this account. It works the same as a checking account. So you will always have access to your home equity when it arises, and you're only paying interest on what is being used. So financial advisors, this is another great product. When we first started out in 05, this product was called the Home Ownership Accelerator. We're almost done. I'm going to show you guys in just a few minutes where you can do the simulator. So just bear with me here. But the benefit of the financial advisor is so many financial advisors. I mean, your goal is long-term planning, right? Investments for your clients, having them be financially free, funding their retirement, allowing them to have more money to pay for their kids' college or whatever it is may be. Maybe their kids' school, maybe they, lost their job or got into an accident and now they're on disability, but they never had disability insurance. There's so many benefits to this loan as long as somebody has equity, to financial advisors to share this loan with their clients that need more liquidity, that need more money, or will allow them to be their clients to be financially free. When this loan started out in 05, we used to have a marketing agreement with a very, very large, well-known financial institution. I don't know if I'm allowed to say, so that's why I'm not, saying it. But they believed in this product so much that we aligned with them and they offered this to their clients. So it is amazing, and financial advisors really need to know the benefits of this program so that they can share it with their clients and allow their clients or help their clients to essentially become financially free. So the benefits that we talked about is, paying off your home in record time without making any additional mortgage payments or any additional changing to your spending habits, saving thousands in interest over the life of the loan. You have 100% access to your home equity. You can use the equity to create generational wealth. You can use the equity to give you peace of mind if you lose your job or whatever. And so this is where you're going to do the simulator. And a couple of things that I need to point out with the simulator. First, you're going to go to aioloan.com. Okay. You're going to compare this product with either a loan that you currently have or a loan that you're thinking about getting. I had a client call me yesterday. They did their first mortgage with me. They're debating between this product and a regular home equity line of credit. So I did the simulator for them and I compared this loan with the mortgage plus a possible home equity line of credit. So if you're doing a potential loan, you have to put the information into the system as to what that potential loan is going to be. What's the interest rate going to be on it? What is the term? Is it a 10-year, or 30-year, or 15-year? What is it? Right? So you need to know the terms of that potential loan in order to get an accurate information. It is going to spit out exactly how long it will take you to pay off the loan with the all-in-one loan compared to the new loan. It's going to show you how much money and interest you will save over the life of the loan. Okay, it will show you what the average interest rate would be. Now, in order for you to get an accurate reading on this, okay, there's a couple things that you have to be very cognizant about. And if you want me to do this with you, which I will, we can schedule a call. Go to bookwithd.com or bookwithdanielle.com. That's going to bring you to my calendar link. There is an all-in-one loan spot where on my calendar. So that way we have the spot, we have the time set aside. I will need a copy of your mortgage statement or what you're thinking about doing. We're going to talk about, what your options are, and then we can do the simulator together. If you want to do it on your own, okay, when you run this scenario, it's going to be, you want to be conservative, but you can also be aggressive. And what I mean by that is you need to put the accurate income amount into the system. So you want to make sure that you're putting your net income from all sources. So if you get a direct deposit of $14,000 from your main job, you're going to input that. If you have rental properties, okay, and you're netting $1,000 a month from your rental properties, well, then that would be a one-time deposit monthly that you're getting. If you get an annual bonus, okay, however much, $20,000 a year, you get a bonus. You want to put that in there, right? Because it's going to flow through this account. If you get a quarterly bonus, of $50,000 a quarter, okay, you want to put that in there. If you're not sure what your bonus is, or you want to run the scenario without all of the extra income and only with your direct deposits, or you want to run the scenario, actually like aggressively, meaning you're putting all of your income, your idle, you got $50,000 sitting in a checking or savings account, throw all of that into the simulator, because that's going to give you an accurate reading. Okay. You also want to make sure that you're putting your accurate monthly spending, and that should include all of your expenses as well as anything you have towards investments. For me, for example, I have obviously my direct deposit minus my 401k money that goes directly to my 401k, but I also have rollovers from other companies, and I also have other investment accounts that I pay to Ameriprise every single month. So if I'm going to accurately put in my monthly spending is not just going to include going out to dinner, paying my car bill, paying FPL, and whatever else. It's also going to include any money that's going out to investments. So you need to make sure that you're accurately putting your monthly spending in there, because what it's going to do is it's going to tell you how much money after closing how much money at the end of every month you are going to have left over. And that is the big kicker with this loan. Okay. It's cash flow, how much is coming in, it's how much is going out, and then at the end of the day, how much is left over. And that's why in the beginning of this, I said it is not going to be for anybody that spends every single dime they make every single month. Because if you have all of your money coming into the account and all of your money going out of the account every single month, your mortgage is never going to change, right? It's always going to stay that same $800,000 or whatever it is. So you need to make sure when you do the simulator, it's going to ask you either for a dollar amount, how much is it going out each month, or a percentage. If you want to say maybe 10%, just to be conservative, I said I save 10% a month, each month that will stay in that account, or you can do the math on it. But you want to make sure that when you do the simulator, to get an accurate reading, your net income, any additional income, and your expenses every month, and how much is left over has to be in there. So a couple of questions that I get, and I just want to check the time so that way I can be cognizant, for everybody's time. We've been here an hour and a half, and I really appreciate everyone sticking with me here. But sporadic income, it's perfect for people with sporadic income, because as I had mentioned, right, if your income is here and then here and then here and then here, you're not going to get hit with those 30-day credit rates if you do not put anything into the account. I've had people say, well, what about a 15-year mortgage as opposed to the all-in-one or a Heloc? As I had just mentioned, it's all about cash flow. So you might want to compare it to a potential 15-year mortgage in the all-in-one loan, right? Maybe you're going to pay it off in 7 years because of your cash flow and your savings. Maybe you want to compare a 30-year fixed with a Heloc. You can do that on the simulator. Some people will say, well, what if I just make additional payments on my regular mortgage? So instead of making my monthly payments, I'm going to make bi-weekly payments, right? That should pay my home off in 15 years. Yes, that could pay your home off in 15 years. If that is the only thing that concerns you and the only thing that you care about, well, maybe that's something to consider. But if you want access to your equity to be able to use for a, God forbid, bad situation, a rainy day, to go on vacation, your kids' college, or anything like that, and you don't want liquidity problems or stuck equity, which I don't even know if stuck equity is a thing. I think I made that up. But anyways, stuck equity, then yeah, maybe just make the biweekly. But if you want all of these other benefits of saving thousands of dollars in interest and access to your equity, then, I would certainly look at the difference between the 15-year and the all-in-one. I've had people say, what happens if the bank shuts down the line? And I myself asked the same exact question, because I was around in 05, 06, 07, and 08 when they were shutting lines down. And if you think about it, those were the times of 80-20 loans, right? 100% financing, no income, no assets. If you had a pulse, you got the loan, and rapid depreciation. Those loans do not exist anymore. Okay. The depreciation that we saw, like that, they compared 2008 to back in the Great Depression. I don't think we're going to see that again. Are we going to see a recession? Are we in a recession? Some may argue yes. I personally think we are going to see a recession, but they are not going to shut down your line. Okay. Anything is possible, but I did confirm with the head of the department. I did ask that question. Okay. It's not going to happen. Would I ever have disclaimer? I mean, possibly it could, but no one thinks it's going to happen. Would I ever have to refinance again? No. I mean, if you are in this product and you want to, 10 years down the road, right? You have a lot more equity. You want to refinance because you want to take more money out of it. Well, then that would be a reason to refinance, but you never really have to refinance it again. So I am going to look at some questions. I know we're a little over. Actually, we're right on time. It's 11:30. So everyone's been here an hour and a half with me. As I had mentioned, lendfla.com is my website where you can apply online or have clients apply online. Book with D or Book with Danielle, both of them go to the same Calendly, is my calendar link where we can certainly set up a time to talk about the all-in-one loan. If you're a real estate agent or a financial advisor on here and you want to talk about growing or scaling your business, then I definitely would love to talk with you. Just go to bookwithd.com. We can schedule a meeting. And that is pretty much it. I'm hoping that I was able to really clearly explain this product. I know it's so difficult sometimes. If you go on my YouTube channel, please like and subscribe. By the way, I'm trying to get more users, but I do have a lot or viewers or whatever it's called. I have a ton of videos on the product. I have a lot of short little clips on it as well. Short clips that you can share with your clients. Don't forget to grab the FAQ that is in the chat or in the Q&A. Oh, actually, I think the chat is not working. So I will be sending the two things that I was going to send you earlier. I will be sending them to you via email since the chat was not working. I'm not sure why, but at least that was our only technical difficulty here. And I'll send this video out. If you want to, send it to your clients, please feel free. I have an email that I send to every client that's interested. It has all of the different videos on the product as well as the frequently asked questions. If that is something that interests you, I can send it to you also and make it your own, tweak it with all of your info in it. And that's pretty much it. Does anybody have any questions for me that you want me to answer before we hop off? Or are we all good to go here? I think we're good to go. Like I said, you know where to reach me, lendfla.com, website, bookwithd.com, schedule a time, real estate agents. I love helping you grow and scale your business. I will be sending this out, the replay, to everybody. Thank you so much for being here. I hope this was at least worth an hour and a half of your Wednesday, and I will talk to everybody later. Have a great day. Bye.